say one has exported and they're an agent, and they would want then to make the downstream payments to the actual exporters, then they have to operate what we call a Nostro FCA transitory. And then other highlights of the policy are that because this is what has been coming up from the players in the different sectors, and we thought that we need maybe just to clarify. Foreign tourists, they are still expected to pay for services when they arrive in the country in foreign currency, and the tourism operators, we have an accounting method through what we call the Trust 1, Trust 2 forms, which they complete at the end of each month, and then they submit to Reserve Bank. Small-scale gold producers, gold miners also, we have added them. They are still receiving a portion of their proceeds in foreign currency, simply because these are for exports. And then tobacco and cotton farmers, they are also still receiving part of their payments for deliveries in foreign currency. Again, the concept being that these goods are being exported. So they are more or less like the downstream exporters that I was talking about. And then for international remittances, they continue to be payable in foreign currency. So the beneficiary actually has the option to say, should I receive in cash, or should my funds be put in an account, or do I want to liquidate and get Zim dollars because they have got local expenses? Maybe just those who are at the back, their seats in front. I don't know if they're preserved for anyone, but I'm sure you can come through. So, whilst it is not a criminal offense to be holding US dollars or any foreign currency in the country, the requirement, however, is that for all purchases, domestic purchases and domestic transactions, one would have to liquidate their foreign currency at the bank or at the Bureau de Change in order to be able to obtain the Zimbabwe dollars. And then other supportive monetary policy measures that were also announced. The Reserve Bank adjusted the overnight window upwards from the current 15% per annum to 50% per annum to help fight inflation. And we also removed administrative limits on the operation of Bureau de Change. We have even gone further to enhance the operations of the Bureau de Change, to include transactions such as business travel allowance. Prior to this, the Bureau de Change would only deal with small transactions, so to say, for persons, for individuals, rather than for corporates and etc. But now we have enhanced their operations to include services such as business travel allowance, education. So if you want to pay for Cambridge, or you want to pay for any subscriptions overseas, then this would also be made from the bureaus. Medicals, we have even gone further to say there are some individuals who receive pensions. They've worked abroad or outside the country, and they are receiving their pensions here in Zimbabwe. In most instances, they would receive these through the banks, but we have said they can now receive these through a bureau. So it would be up to a person then to say, through an MTA rather, it would be up to a person then to say, once I've received my money, what do I do with it? Do I want to keep it for the meantime, or do I want to exchange it for Zimbabwe dollars? Or do I even want to deposit into Nostro FCA? Micro, small and medium enterprises, they are also allowed to sell and purchase foreign currency from Bureau de Change. and this also includes cross-border traders. There are some limits that we have given there just for issues to do with anti-money laundering requirements. And then also we have put a vesting period of 90 days on disposal of dual-listed securities on shares purchased by investors on the ZSE to curb speculative tendencies and externalization. Now, what are the implications of the introduction of the local currency? I've just rushed through the policy measures that have been introduced. From our side, the implications are that, one, we have halted the what we saw which was coming, which was the re-dollarization, which was going to come at a cost. Economic agents were reverting to using the US dollar as a unit of account and a medium of exchange. Improved monetary policy effectiveness, because now we can control money supply when we would want to influence inflation and to maintain price stability going forward. Increased fiscal space for the government through increased revenues from local currency-based transactions. And then management of current account deficit. It allows use of the exchange rate policy to enhance export competitiveness. What we have seen since the introduction of the Zimbabwe dollar, from the official or the formal market, there's been an upsurge in the purchases of foreign currency by banks, especially at Bureau de Change. You find that the rates there have been quite competitive, and you'd have individuals, you'd have companies going to sell their foreign currency. The introduction of the local currency will also assist in the build-up of reserves, because now the foreign currency that is there, as long as it is now preserved for imports of goods and services, it means that whatever we need to do locally, we then need to use the domestic currency. Okay, and just to conclude the outlook, how do we see things going forward from a central bank perspective? We undertake to actively implement monetary policy with transparency and consistency. The exchange rate is expected to stabilize, and then inflation rate also to decline in the medium term. We also expect fiscal authorities to continue implementation of fiscal consolidation as enunciated in the Transitional Stabilization Plan. Pricing and accounting is now going to be easier under a single domestic currency and unified exchange rate framework. The Reserve Bank remains unable to input from all stakeholders. Hence also why you see our presence here, to get input also from our relevant stakeholders, so that at least when we are implementing policy or we are announcing policy, we've got such input. However, support of economic stakeholders is still critical for the success of these currency reforms. That is all. Thank you.
Another round of applause to Mrs. Tembo. I think it came out clear that it's not a criminal offense to hold US dollars. I had that part as well. And also that the key point for me is the end game that she mentioned, that the outlook is towards exchange rate stabilization and therefore inflation containment. I think those are key issues that have got a huge bearing in terms of the savings industry, if we are to remain relevant. So I think we're happy with that end game, and hopefully we can move towards that. I would like to call upon the I.C.A.Z CEO, Ms. Gloria Zvaravanhu, to come and give us a perspective on the SI 142. Why are we having Ms. Zvaravanhu? It's because we also want to understand the implication in terms of reporting, because pension funds at the end of the day, we're also reporting on how we're carrying these operations. Mr. Rawan.
Good morning, ladies and gentlemen. First of all, I just want to thank you very much for having us here as the Institute of Chartered Accountants. We also take opportunities like this quite seriously, so that we also engage with you and understand some of the issues that you'll be going through as far as reporting, so that we're also able to issue guidelines on any complex issues that could be arising out of these reforms that we're going through. But also just an opportunity to share some of the key issues that are arising as far as reporting and just general financial management from the currency reforms that we've experienced recently. So in my view today, much as we are looking at SI 142 because it's the most recent, I think it's been a journey of a number of instruments that have culminated into where we are now, and they all have an impact in one way or the other on reporting, on financial management, as well as on the essence of the whole concept of pension and the fact that you want to have some value at retirement. So I will try to borrow from what Madam Charity did, which is to really look at the chronology of events that happened and just touch on how those were developing and the implications that were arising out of there. I think we do all know that February is a very special month in the sense that February 2009, that's when we introduced the multi-currencies. And for pension funds, what did that mean? Certainly, there was some loss of value on those that are holding monetary assets. I think we all know that balance sheets were eroded, and value was stored by those that had assets that were able to contain the pressures of the previous hyperinflationary period that we had gone through. So in particular, I think the brick and mortar land and buildings. And I want to believe that when we look at the profile of investments for the pension funds in general, most of the assets are in property, or maybe 60% are a mixture of property and your stock exchange. So I think the key lesson, obviously, that was picked from that period was to ensure that as we look at investment options for the pension funds, we definitely need to have a good mix of those that will give us the cash flow when we need to pay out, but also preserve value in a turbulent monetary environment. So I would want to say February 2019, I think we sort of went into a honeymoon phase between 2009 and 2016, in that we were in US dollars. We were enjoying the US dollars. In fact, I really miss those days because, I mean, we were really holding real cash. You could go into a bank and withdraw 10,000, no question asked. You could actually withdraw 20,000, no questions asked. But you know, when you look at it, you say to yourselves, in the United States, for instance, if you go and you have $100 bill and you're going into a shop to buy, they actually look at you twice or three times. Where are they getting this cash? Why are they holding cash? But here we were holding 30,000 US dollars at a point in time. So perhaps, Madam Charity, I think as far as the regulations there, perhaps something could have been done there to preserve that so that we then ran into shortages. I think when we go to October 2016, we do know that we were now having liquidity issues. And that is when the bond notes were introduced via SI 122. And obviously what that meant was that there was the development of a premium between the real US dollars cash and the electronic balances. And in my view, I want to believe that's when we really started having a different currency. You know, substance over form prevailing there. I think that's when we really started seeing the difference between the real US dollars and the currency that we had in our bank accounts. October 2018, I think we're all familiar with the monetary policy statement that introduced the separation of nostro balances and RTGS balances. So that was a clear submission now that there is a premium. Previously, I think we were talking 1:1 parity, and I think the premiums as well were sort of contained below 30%. So it was sort of, I think we managed our way. But 2018 October, I think that's when the widening of the gap really became quite significant and very fast in a few weeks. So I would want to say perhaps this is when we can say, you know, the local currency was really in effect. To be honest, when we look at it from a reporting and accounting point of view, this is really when we could say we had a change in functional currency for most organizations, and I want to believe for pension funds, most of your economic activity was probably domiciled in the RTGS balances and not so much the nostro. I want to believe so, because most contributions would have been coming from the contributors in RTGS form. So the question that rose there between October 2018 to December is, so are we correctly valuing the assets? Are we correctly valuing what we have on our balance sheets? Are we correctly valuing the contributions that are coming through the USD or another currency? In 2019, in February, that's when we then introduced the RTGS as a currency. So it joined the basket of multi-currencies through SI 33. And SI 33 then described that for reporting, accounting, and other purposes, from that date going backwards, it was 1:1. So what's meant is that for pension contributions, which were outstanding, which had accrued as US dollars, at that point in time, they were RTGS, they were equivalent to 1:1 with the US dollar. But the question remains that there was loss of value definitely for outstanding contributions. We should have been collected in US dollars. We're now being collected in this local currency at a much lower value. So there was yet another wave of value loss for the pension funds. Unless the monies that had been collected from those contributed were also going into assets that reserve value, I think this was then possibly another repetition of what happened in 2009, where there's yet another wave of loss of value for the pension funds. In that same period, some pension funds might have been still receiving some contributions in foreign currency, I want to believe, for some pension funds, because we're still in multi-currency, so that was allowed. Then they came about the issue of legacy debts, when we talk about the 1:1, and the fact that those who had outstanding approved foreign payments could apply through their bankers to the Reserve Bank for legacy debt at 1:1. I also want to believe that this is not quite prevalent with the pension funds, because I want to believe you don't have that many foreign liabilities, perhaps save for things related to systems and things like that. So this might not be a big issue for the pension funds, but the fact of the matter is that we had this significant debt of 2.1 billion, which is not clear as to whether it's been assumed by government or not. I think, Madam Chair, perhaps in questions and answers you could actually assist us in this, because for reporting, what it then means is, unless there's a written commitment or you have some letter of credit or some agreement from the Reserve Bank that is confirming that your legacy debt is going to be settled at 1:1. Unless that's in place, you have to revalue that debt at the interbank rate, and keep the possibility of you recovering from the Reserve Bank as a contingent asset, with something that you keep off balance sheet and hope that when you do recover, then you put on balance sheet. But I'm hoping that this issue is not prevalent for pension funds. So what happened to the contributions, that were accrued as real US dollar, and now we're still outstanding. So what it meant is that for those organizations that were not complying and not contributing on time, they tended to benefit, at the expense of those that were contributing on time. So again, this is yet another situation that could compromise collection in the future for the pension funds, because some organizations might feel like, look, we're in a cycle where things can change, and those that are owing tend to benefit at the end of the day. They might withhold pension contributions simply because they're waiting for an event to happen that will make those values less. But we are here. I know this room is full of principal officers. I think what we just need to be mindful is the fact that we are also going to be pensioners one day. So whatever decisions that we are making as we remit the contributions, as we manage the contributions in form of preserving them, we must know that one day we're going to have to benefit from a system that would have created ourselves. And I think that's why IPAC really is there to try and help us see that and monitor that, because sometimes we can be short-sighted as we're managing these things. We feel that it's for those that are, getting the pensions now without realizing that we are also on the same journey, and therefore we need to be a little bit more responsible so that we have meaningful pensions in the future. So moving to 24 June 2019, this is where SI 142, which is, really the theme of this breakfast meeting, came on. And I think this is really when the honeymoon ended, in the sense that we removed the multi-currencies as legal tender, and so only the Zim dollar or ZWL or D, I don't know, then become the only legal tender in the country. And I know some speakers, we've been talking around SI 142 and saying, all along we were playing with the US dollar, the pounds, the rand, and those were like the small house or the civil partners, so to say. And now we're back home to the main house, It had to be for a point in time. It wasn't going to last for too long. I think we had a good time with the multi-currencies. But then at some point you need to go back home and face issues at home. And I think this is where we are right now. We are at SI 142, we are back in the main house, and now we have to say what are the issues that we have to deal with. So what are those issues at the main house that we have to deal with? I think, number one, the issue of valuation of assets. I think for pension funds, especially around properties, I think when we translated from USD to RTGS using 1:1 as what SA33 prescribed. After that, we clearly know that those assets that were bought in US dollars, that we converted because they were non-monetary, they were not foreign denominated. For instance, if you bought a building 50,000 US dollars in September 2018, for argument's sake, at this date, unless you do a revaluation, it's meaningless in your balance sheet, and yet it's got a store of value in it. So I think the call will then be to ensure that there is proper valuation of assets. And around this matter, it's not an issue of just taking your 50,000 and saying what is the interbank rate now, and multiplying and coming up with a value. I think international financial reporting standards require that your assets be valued at market value, and that entails having proper valuations by expert valuers all those properties. So the values might not necessarily follow the exchange rate, but they look at a number of issues. So I think that is quite key for pension funds right now, to revalue your balance sheet so they reflect the correct value as we stand right now. The second thing that we have to contend with in the main house right now is value preservation. I think we still need to be looking at what instruments are available to make sure that store value from the contributions that are coming in now. I do know that as far as dually listed shares, Madam Charity, that there is now a restriction. I think it was introduced via SI 152, all the related guidelines that came that you cannot, when you buy these shares, you cannot sell them within a period of 90 days because it was said they've been used for speculative purposes which wanted to be kept. But for pension funds, I do know that our investments are generally with a long-term view. So this should not affect so much. I think at the moment when we look at the instruments that are available, it's your property, your land and buildings, perhaps the stock exchange, because you expect that will also mimic whatever inflation is on the ground. The other investment instruments, I know that Mr. Phiri won't like me because he wants you to keep a certain amount of liquidity for purposes of being able to meet payouts, or claims as that may be. But I think the real issue is going to be value preservation, because we are almost in that stage where we're back to your pre-2009 era where there's a lot of inflation, which I'll touch on a little bit about towards the end, and we need to really be finding good homes for the assets that we have. The issues of pension values, I think we do know that at the moment salaries are not adjusting at the same rate as the movement in the exchange and so on and so forth. So certainly we are going to see lower and lower contributions to the funds than had been in the past, where it was in real US dollars. So the question becomes, how do we make pensions relevant for someone today who's working today? How do we make them relevant so that they actually believe that this is an instrument or this is a product that they need for when they retire? So I think this is a critical issue that we need to look at when we look at the pension funds. The administrators, I suppose, will need to be very creative and innovative and try to come up with products, I think, that might be able to excite, because we might be at that phase again where people sort of shun pensions, which happened, I think, soon after the multi-currencies. People were doubting, they were not very sure whether they should part with their US dollars for pension that they'll get in the future, and they don't know what value that is. And I think it has turned out true. Because, I mean, we contributed US dollars, and today we are now talking about a different currency, and we're not sure to what extent value is going to be held. Inflation. So there's questions to say, are we now in hyperinflation again? And just to share a few statistics, as at April 2019, the cumulative 3-year inflation rate was about 81.5%, and the conditions for us to be able to declare whether we are now in a hyperinflationary environment is where the general population regards monetary assets not in terms of the local currency, but in terms of foreign currency, where there's just a general preference to have foreign currency. So when one gets their salary, they might be preferring to quickly convert it into another currency for value preservation. And I think we know that this is happening. The other condition is when the general population prefers to keep its wealth in non-monetary assets or in a relatively stable foreign currency. Again, we've spoken about how we will need to preserve value for the pension funds, and obviously looking at instruments that preserve value. And the last one is the cumulative inflation rate over 3 years should be approaching or exceeding 100%. And I've just shared the April cumulative 3-year at 81.5. We do know that June 2019 year-on-year was 175.6. Mr. Hoto is here. He's probably going to share more light on the statistics where his other hits with Zimstats as to whether these are the correct statistics or not. But I think clearly we are coming to a point where we're probably above 100% when we look at cumulative inflation over a 3-year period. However, we don't just decide, so entities don't just decide that, oh, we are now in hyperinflation, so we start hyperinflation accounting. So it's a determination that is undertaken at national level. The Public Accountants and Auditors Board assists with it at the moment. And the reason why the international standards are not prescriptive is that you don't want to overreact and say we are now in hyperinflation simply because maybe inflation has gone up because you're in an adjusting period or transitionary period. So I think you need to allow it more time. I know the Minister of Finance in one of the conversations he had in the last month was talking about looking at it in October because I think he was optimistic that the inflation will start coming down. Maybe we won't be in hyperinflationary zone. But I think I think all will be seen and decided on. I think by the time we report for December, I think we would have seen where the inflation rates are going. The last thing I think to contend within in the big house or in the main house is the issue of qualifications. I think you know qualification of accounts that all, if not most, of organizations, pension funds, entities had their accounts qualified for the period starting December 2018 because of the fact that we were valuing it 1:1 when in substance we know that there was a premium. But the challenge was that there was no market observable rate to use for that translation. There was no interbank before 22 February 2019, so we could not determine a proper market rate. And on top of that, we had SI 33, which basically prescribed the law, which said translated 1:1. So you're either qualified because you didn't comply with the International Financial Reporting Standards, or you'll be qualified because you didn't comply with the law. So it was a catch-22 situation where most organizations had to live with the qualification. So the questions in most people's heads is that at what point are we going to see these qualifications going away? So I think that will be determined by, of course, how the events turn out. If we are now going to be into hyperinflation, again, that's another issue that we'll have to contend with as a country. But it takes at least 3 years to clean out an adverse audit opinion because you're looking at prior year numbers. For you to clean out the prior year numbers and have a clean opinion, I think you can look at a period of minimum of 3 years. And of course we know that that is not very good for us as a country, especially as far as attracting investors and financiers, because you can't have a set of accounts where no one can place reliance on. Because that's what it means. If it's qualified, it simply means we can't place reliance on these numbers. And it was left to the preparers to now explain in notes why the auditors could not certify those numbers. So it's not a very good situation to be in as a country. So I think I've said enough. I think they certainly are developing issues, obviously, as the currency reforms develop as well. I think we do know that 2 days ago, Madam Charity you introduced yet more regulations around the currencies where you expanded, or at least exemptions. Or are there clarifications? Yes, we do know that there were some who are now exempted from trading in US dollars, like your international donor organizations, is it oil and com organizations. So I think all those, perhaps if they're contributing in pension funds, the other issue is will they have products that are in US dollars, or they contribute their pensions in US dollars. So I think with that I will rest my case for now.
Thanks to Gloria. For those that are still by the door, there's space in the front. You can come in. I think we're now delving into the actual issues while we're here, isn't it? I think the takeaway is the issue of the valuation of assets, the issue of value preservation, the issue of product innovation, the issue of are we in hyperinflation or not? Are we being alarmist? Is another question. So I think these are issues that we need to be looking at, and indeed, it's to a transition. like the Reserve Bank is still issuing out clarification on that SI. And our hope is that the pension industry can also find some space in the clarifications where we can also be able to bring about that issue of value preservation. So indeed, the honeymoon is over, and at the main house, that's where the interesting conversation does happen. And yeah, sure, we also want to have another session on that marriage. Guess what? It does affect the operations of a pension fund. And part of your estate planning is also taken care in that marriage bill. So we want to have another session on the marriage bill. All right. I think building up from the issues of value preservation, product innovation, I would want to call upon the Association of Investment Managers Chairman, Mr. Jubelah Magutakuona, so that at least we can delve more into the issue of value preservation and investments. Jubelah. Next.
Good morning, all. I would like to thank ZAPF for inviting us here. So we continue with issues in the main house. Yeah. So I'm coming from the Association of Investment Managers of Zimbabwe. There is 17 of us in this market who are licensed by the Securities and Exchange Commission of Zimbabwe. We collectively look after 6.5 billion Zim dollars. 6.5 billion Zim dollars of mostly pension money. And so, you know, we have an interest in developments that affect the pensions industry. We're part of the bigger family of the pension sector. So, you know, my contribution is really going to be about the market response to the statutory instrument that has come out. We, again, are also taking a view that it is not so much about, SI 142 is part of a cocktail of measures. And so the market has been responding to this cocktail of measures. And so I'm going to, you know, you could spend perhaps a whole day discussing, you know, the market's response. But what I'm going to focus on is the implications to risk. Because in the field of investment, what is happening there is actually managing various risks. And so what risks are being amplified by the emergence of the statutory instrument? I'm going to start with inflation risk. So I've got just 7 risks that I'll quickly discuss, which perhaps are a priority as far as investments in the present circumstances is concerned. So the first issue is inflation risk. And whilst the accountants are saying, you know, perhaps it's still debatable whether in hyperinflation or not, what's important is the market cycle. The market cycle is already in hyperinflation. That's what it is. And so you have to be mindful about that. The accounting, those are technical definitions. but you have to respond to that. So I'll share with you a few statistics. So you know the June inflation, which is reported year on year at 175.7%. And she gave the April a figure. The latest figure for June in terms of the cumulative 36 months inflation is 185%. You know, so already that is well beyond the 100%. Then there's obviously the debate about, whether we are going to be, closer to the 100 or not. But what we are seeing is that year to date, for the first 6 months of this year, that is from January to June, cumulative inflation is 94.5%. So unless we are going to have negative inflation between now and the end, I struggle to imagine how even by October we can be talking of, figures that, around the 20% as the forecast has come from the authorities. So it looks to us that we are going to struggle as an economy with the issues of inflation. And obviously because the inflation is being measured now in the local currency, and there is obviously a concern around it. So far, even if you held a portfolio of stock exchange assets, inflation has cleaned you out, because the ZSC's performance for the first 6 months of the year is 4%, but inflation has been 90%. So you would have only been able to outperform inflation if you were actually holding US dollars. We have been told that it's not illegal to hold US dollars. So that's the only asset, perhaps so far, in the legal market that could have actually been able to protect value versus inflation. And so the next risk is compliance risk. And I'm glad the regulator is here so that we can have a very good discussion around this issue. In investments, we are required to have to invest now 20% of our assets or the pension assets in prescribed assets. And the prescribed assets are mostly fixed interest assets. And so you can imagine when you try to reconcile a fixed interest instrument and inflation, very high inflation, it is a very difficult proposition to think about. And so I know there has been a discussion around regulatory forbearance, but it's not that the pensions industry or as investment managers who are the execution agents of pension funds, it's not that we don't want to participate in these assets, but we want to do so in a manner that preserves value. And so our proposition is that perhaps through the Reserve Bank we can have some inflation protection, instruments. Since they think that inflation will be coming down, there's really no problem with you issuing inflation. Inflation, because your argument is it's coming down. We are fearful that it will be going up. So it's a win-win. So to us, I mean, it is an issue. And perhaps for the regulator to expand their qualifying criteria for prescribed assets, so that certain securities or certain, even a fund, if I start a fund that is invested in various, value-preserving assets, say I have got a property fund, a property fund that is advancing the interests of humanity, shouldn't that property fund be given, prescribed asset status? Shouldn't it contribute to prescribed asset status? So that's really the argument we are making to the regulator to review the, qualifying criteria for prescribed asset. The third point is obviously currency risk. Whilst previously you would have invested with the thinking and perception that these were US dollar assets. Gloria made a point that as you were contributing with perception that they were US dollars, although they may not have been US dollars, because you were not earning US dollars. It's a different argument, but the issue is that the perception is what mattered. You thought and acted as if you had so contributed US dollars. But we are in a phase where we are we have delinked and we are now in the domestic currency. How do we disabuse market of this notion of US dollars? Because we have tested, right? How do we, to use a example of the small house, how do you forget yours? Yeah, yeah, because you know what, it's been so many years, and we have kids, with the small house. So, so, so how do you just, yeah? So it's a complex situation for us as a market. It is the right, when you look at the economics of this country, it is the right decision to have a local currency. It is the right decision. It is not sustainable to, run an economy on a very strong currency like the US dollar. But, how do we disabuse the economy? How do we disabuse the economic agents of the use of this dollar? So what we are seeing here is that, why we're highlighting this risk, is that whilst the regulatory and the legal framework has introduced a monocurrency, and whilst people may comply or are going to comply with that, but the pricing regime is going to be dollar denominated, or that's what it is, and it's going to take a long time. So if we think about investments, we have to think about pension now. As you get paid, you get your pension payout. That's the sort of pricing regime that you are going to be facing. So currency becomes a concern to you, and so is a concern to us as we select investment assets. Now, the fourth risk is price risk. Price risk here, I'm really talking about the stock exchange prices. There is extreme volatility in the markets. You can imagine the markets have been trying to take all of this in. Markets is where, a lot of issues are expressed. The fears, the anxieties, the excitement, all comes through and is expressed through the mechanism of the markets. And so, whilst we may not totally agree with the view that the old mutual share price was being used for speculative purposes, it's a market. It was merely expressing market sentiment. That's the view that we take. We feel that whilst a measure is put in place, when the next 90-day cycle, first 90-day cycle comes on stream, there's going to be continuous transacting. So we have seen the share prices of both Old Mutual and PPC adjusting back, but I think they are back up after having cleaned out perhaps that noise. There's the issue of dollar-denominated dividends. You have got nostro accounts. So the balances that are already there, they are free funds, I suppose. There's no need for automatic liquidation. The dollar-denominated dividends. So for pension funds. So those ones are, in our view, they are free funds. They are in accounts. But the moment you want to utilize that, you obviously have to look at the exchange control regulations. If you are importing, I don't know what you will be importing as a pension fund. But it's more likely that you will be using that in the domestic economy, and therefore are required to have to convert at the interbank rate. But our expectation is that going forward, the future dividends in those external companies should continue to come in the currency in which they are declared, if they are rands or they are US dollars, and then go straight into your nostro. We hope that regulation will not be adverse going forward, in in that aspect. Then we have got the risk to highlight, which is the interest rate risk. Because if you have got, I mean, you want to look at the SI 142 together with the regulations that then came from the Reserve Bank, where the Reserve Bank has already alluded to the adjustment in the overnight rate to 50%. And I think some 2 weeks ago, the Reserve Bank was in the market with, treasury bill issuances, where I think the 90-day rate was 16.5. The I think it was what, 30-day, 90, 180, and what, 360, 365. So you are looking at the TB yield, average around about 17%. So they've adjusted upwards. So if we were holding a portfolio of assets, of money market instruments, which are classified as held for trading, you obviously have to face some mark-to-market losses or profits, depending on which side you are looking at. But it's very likely that your running yields on your portfolio would have been lower than what we're experiencing. And going forward, it is our expectation that the interest rate trajectory will be, on the up. And therefore, you have to be mindful about that if you are holding a portfolio of assets, that there could be mark-to-market losses which are coming from the interest rate market adjustments. Then there are two interrelated issues which have come as a direct consequence of both the SI 142 and the I.C.A.Z directive, which is liquidity risk and credit risk. So I think Gloria alluded to the legacy debt issue, where the figure rather is not 2.1 but 1.2 billion, $1.2 billion. The idea being that those who had legacy debts on their balance sheets are expected to transfer that amount to the Reserve Bank. So this will have an effect of sucking out market liquidity. When the directive was issued, or when SI 142 was issued, total market liquidity on that day was $1.6 billion. It also happened to be a month in which we had to dealing with QPDs. And so if all this 1.2 billion had been taken out of the market, you would have had a very tight market condition. And really, that's really what is still there right now, because that process is still going on. The idea being that, because it happened simultaneously, that requirement to transfer the 1.2 billion and also the adjustment in the interest rate. The idea was that if you didn't have the money on your balance sheet, you could go and borrow at 50%. There was an incentive for you to do that, especially in my understanding if you were swapping one-to-one for an asset that will immediately revalue. If you were, because my understanding is that even if it is an off-balance sheet asset, it is immediately revaluing to the interbank rate. So you would have immunized your balance sheet because you've got an obligation and you now have an asset, So there would have been incentive, even if you were funding that asset at 50%. The motions are still going on, but the point is that market liquidity has been kept very tight. And so you see that when you want, say, to liquidate your portfolio, even if it is selling a property or selling stock exchange assets, it's taking a bit of time because of the tight, market liquidity. Then there's the issue of credit risk. So obviously, because interest rates are adjusting upwards, the capacity, cash flows are under stress, so the capacity to actually pay back debts is constrained very, very significantly. I think we are worrying about mortgage rates now. If mortgage rates are rising, your capacity to actually stay in that house is also getting a little bit constrained because salaries have not been adjusting at the same rate, Therefore, the impact is perhaps, fairly significant. So we expect that the non-performing loans in the banking sector may actually, be a problem going forward if there is no ease in terms of the liquidity and credit conditions in the market. I think I'll end here. I hope I've been within my time, and we'll discuss the questions later. Thank you.
Thanks, Jubelah. I think the key takeaway there is you are operating in a minefield, and you are mindful of the fact that you are taking care of people's monies, and you want to ensure that, number one, there is value preservation, and then thereafter growth, which is the issue that inflation is actually bringing to the fore. So I think the issue of inflation is actually coming out in all these presentations that we had. And I think it is the elephant which is in the room that we really need to then tackle and say, how best can we ensure that the savings at the end of the day, they are able to hold value for our pensioners. I'll move on to the next speaker. He's a partner within Muvingi and Mugadza legal practitioners, attorney of the High Court and Supreme Court of Zimbabwe, Mr. Nobert Musa Phiri. He's going to come to us and talk to us around issues of the law, as well as issues around taxation as a result of this particular policies, or the policies that we're actually grappling with.
Thank you very much, Chairman. I must say it's a pleasure for me to be before you this morning. And for me, I actually work standing up, so I feel at home when I'm standing. Right? So initially, I came here with the intention of talking about SI 142. Then the marriage bill came about. So I will now talk about the marriage bill. So the chairman here gave us 5 minutes, so I will be short and concise. And my presentation to you this morning is essentially, we have learned nothing and we have forgotten everything, right? It has taken us 10 years, right? February is a nightmare, if you ask me, right? And the nightmare is, it's immaterial whether you pay premiums in US dollars or whether you pay them in US dollars. Come February, normally after 10 years, you are definitely going to lose value, right? So it means we've learned nothing and we've forgotten everything. And what have we forgotten, right? If you ask me, we have forgotten the number one thing. We've forgotten that currency is the number one risk, right? And we have forgotten what the Commission of Inquiry said. I might not agree with the findings of the Commission of Inquiry for one reason or the other. But there's one thing I agree with them, right? There is the currency issue that we seem to neglect and forget each time. Now, we spoke about the cocktail of measures. The previous speakers have talked about Section 1, Section 30, Statutory Instrument 32, Statutory Instrument 33, Statutory Instrument 142. Has there ever been a year where you've known about statutory instruments more than this one? Right? So one thing is for sure, how can you do business in a country where there is such uncertainty? Right? The only legal certainty that I can assure you is that there is uncertainty. Right? Now, Statutory Instrument 32 introduces RTGS, right? Statutory Instrument 33 puts RTGS and USD pari passu. They rank together, right? 142 then confirms to us that we are now a multi-local currency basket, right? Why do I say multi-currency local basket? It's because we've got what we call a bond note in circulation, right? We've got what we call an electronic currency in circulation, and we are anticipating that finally we'll actually have a Zim dollar. Bear in mind, the Zim dollar is actually not there in reality, right? So why am I saying all this? I am saying all this because as pension fund institutions, you need to be real and alive to what it means to your contractual obligations. I don't want to look at the legality or otherwise of Statutory Instrument 142, but let me tell you this. If you want to look at the legality, right, look at the courts. Now, our constitutionalism is one way our constitution is supreme. We have an executive that runs government. We've got parliament that makes laws. And we've got a judiciary that interprets the laws. Now, if you look at the history of our judiciary, right, and whether or not they've been inconsistent to what the executive says, then you know the answer, right? This is not in this period. It's since time immemorial, since 1965 actually, when we read the law books, you will realize that there's a consistency between executive and judicial, right? Bear in mind, it appears the executive at this particular stage is the one that is legislating. So what is the point of the parliament? So again, I say there is uncertainty, right? And we seem to be learning nothing and we forget everything. Now, what should we look out for, if you ask me? Now, there is a myth that because the Statutory Instrument 142, it therefore means all obligations are now in US dollars. That is a myth, right? I will explain why. Now, the regulations came out 2 days ago, right? And the regulations did touch on insurance, where they said if there were policies issued in US dollars, they will be paid out in US dollars. That is what they said. But then there is a disclaimer. They then said they will be liquidated. I'm not too sure what the exact explanation is. Does it therefore mean if I paid premiums, I know from the effective date, that is what you mean, from the effective date of Statutory Instrument 33, if you paid premiums, you'll be paid in US dollars. But this doesn't answer the question for pension fund institutions, because how do you use the word actuarial valuation of the one period? See, a pension policy cannot be defined by a premium which is paid over a short period, right? So how are we therefore going to say this pension which premiums were paid in US dollars will be paid in US dollars partially? We are going to have a legal minefield, right? Now, I said obligations that were introduced in US dollars, or any obligation that you had in US dollars, does not extinguish because of SI 142. So it's incumbent upon you to look at your assets and liabilities. Look at your contracts that you presently have. If they're denominated in US, it does not wake up and become Zim dollar. Why am I saying this? SI 33 specifically says assets and liabilities. Now, for you to understand 142, you need to go back to 33. Now, you see, if I start doing all this, you will not like me, right? It ends up becoming a law lecture, but it's real. And the confusion and the anxiety and the excitement that you have, right, is exactly why I'm saying there is a lot of uncertainty. So when you look at it says, 33 says assets and liabilities, right, are now Zim dollars. Well, there are certain, not liabilities, there are certain obligations that are not assets and that are not liabilities. I'll give you a simple example. For those ordinarily who are in short-term insurance, right, they pay out based on indemnity and pay out what we call damages. If you ask me, damages are not an asset. Damages are not liabilities. So there is a danger, or there is a risk that you are actually going to be facing US dollar denominated claims in the near future, despite the fact that we are now Zim dollarized, right? That is the reality. And might I add, at this particular stage and in moment, it is not legal for a court in Zimbabwe to award a judgment sounding in foreign currency. And it is not illegal for that judgment, which has been awarded in foreign currency, right, to be liquidated in foreign currency. Right? So these are the realities that you need to really think about. Right? So I said we now have a basket of multi-currencies. I'm going to ask, the Reserve Bank is here. So why are we not having cryptocurrencies being regulated then? Because you ask me technically, an electronic currency, you do not touch it. It's the same thing with the cryptocurrency. You do not touch it. It's effectively based on market perception. It's barter trade, effectively, right? And that is what a cryptocurrency is. It's a barter trade. So perhaps the Reserve Bank might start thinking otherwise. It has already worked that we have an RTGS. It might actually work if we have a cryptocurrency, right? So these are suggestions coming out from us. But beyond that, I would like to perhaps implore pension funds to say the issue of currency is real and it's a risk. I would look towards other alternative investments. And I stand here, I work in intellectual property myself. I'm an IP attorney. And you might be wondering, can we actually value intellectual property? And the answer is yes, you can value intellectual property. And I am motivating that intellectual property becomes a prescribed asset. My colleague here spoke about perhaps the prescribed asset needs to change in its nature. Indeed, if you are looking at a patent, right? A patent is an exclusive right that is granted, right, in a field of invention or technology. And imagine if that field of invention or technology is a drug, right? A pension fund has invested in the adoption or the invention of a drug, which tomorrow will make billions and which will contribute to our own community, right? Surely, why should that not be made a prescribed asset? By the way, it has already been done, right? Malaysia has taken the approach where they've used intellectual property, which assets and creations of the mind, they have been valued and they are now being securitized. So if you ask me, intellectual property assets should be made prescribed assets, and there is a valuation method that is available and it has been done. That is the only way we can instill confidence in this particular sector. Now, I also spoke about industry. I want to speak about industry, sorry, and say where should pension funds also invest. Now, there is a cry by industry that we want to retool, we want to reindustrialize. If you ask me, I don't think pension funds should even go there. Why am I saying that? We are in a knowledge economy, right? Where we are driven by intellectual property. Intellectual property is technology-based solutions. Industry is trying to retool, right? Whereas industry is trying to retool, the whole world has already moved forward. We are in the fourth industrial revolution. We need to look at investments that are future-oriented, right? Let's not keep going back. Because the danger in us going back is we find comfort, right? You seem to want to find comfort in the wrong things. You want to find comfort in a small house, right? It is a wrong thing. It will never be a right thing, right? Because it will only lead to you going back to the same problem, right? So if you ask me, our investment strategies should look forward. And we are in a fourth industrial revolution, and if you don't participate, you will be left out. So, in a nutshell, I'm not saying there's anything wrong that has been done by the Reserve Bank, right? All I am saying is you need to be realistic, right? You cannot tell yourself you have US dollars, or you cannot tell yourself you are paying premiums. You might have a currency. Let us all agree. Currency is a problem. Currency is real when it comes to pensions. Every 10 years we appear to lose any value that we have, right? And so for now, if we appreciate that currency is a problem, we need to look elsewhere. Unfortunately, we can't run away from it. We cannot mitigate the risk that is associated with currency, right? So I'm encouraging everyone here to say there's no depth or shortage of attorneys or advocates when it comes to interpretations of these statutory instruments. Please approach us. We are available. But there's one thing that we will definitely tell you, or one thing that we are all going to face. We are in a gray area of the law. There is so much anxiety, there is so much excitement, but there is also a lot of confusion. Let us approach and get proper advice so that we mitigate any other risks that we have. Those books that you are sitting on have a minefield of risks that actually need to be assessed at this particular stage, because already your asset is now in Zimbabwe, but your liability could potentially be still in US dollar, which means you will obviously be insolvent, or you are actually probably you are technically insolvent. You might actually don't know that you are what? You are technically insolvent. So these are real issues, and in conclusion, thank you very much for having me today, but I don't want to scare you, but it's real. It's a nightmare, right? And it's a legal minefield, if you ask me. And with that, thank you very much, Mr. Chairman. I've taken only 5 minutes, and you had given me, and I have executed my mandate. Thank you very much.
Spoken like a true attorney, isn't it? Thanks for that, Nobert. I think the takeaway is that we're in a gray area of the law, isn't it? And we continuously need to get answers as to exactly what we're grappling with. But I think that issue to then say that SI 142 doesn't extinguish your USD obligation, I think it had a lot of people in this room worried, isn't it? For those that borrowed from February up to where we are now, please go and pay back in US dollars. Having said that, I would want to move on and call upon Mr. Douglas Hoto. I'm calling him in his capacity as an actuary, for him also to unpack what the actuaries are seeing from this particular SI. Mr. Hoto.
Thank you very much, Mr. Chairman. Good morning. I used to be an actuary. Let me say that. But somebody who's once an actuary, always an actuary. So we get back to the same place. When I was asked by Sandra to come to this breakfast meeting, I wasn't told what to talk about. I figured out that perhaps there are things that I could talk about. Sometimes I don't need a mic. Because I'm practicing some new career habits that when I take my kid at the next level, I'll be addressing people. So, and there may be no mics where I'll be trying to address people. So, SI 142, unpicked, I think that's for lawyers. I can't read a statutory instrument. It's too long, too complicated. I just ask what it means. Once it was reading it, it's just a problem. So I just said to myself, oh, not again. That's what I said to you today. Not again, Zimbabweans. That's what you are all saying. And I find that very interesting, because you are saying not again. There was a myth being developed by some of the younger presenters that every 10 years something happens. But pension funds are much longer than that, so I will deal with that separately. The 10 years from 2009 2019 are just one decade. If you take the other 10 years going backwards to 1999, 2009 into 1979, when we were in Lancaster House, you will find that there are many different things that you come up with. So I'll pack that. So what does SI 142 say to the pensions industry? I don't think it says anything to the pensions industry alone, but it addresses the economy at large. And the people are saying not again. That's why they're here where they go. The main issue here, which we are dealing with, is a problem of economic loss of value, both in reality and perception. The reality of it is that you were able to buy certain things with this amount of money, and you can't buy them anymore with the same amount of money. Whether that one is the same or not can need another breakfast meeting. But that is what people are feeling. The perception of it is that once you have had hyperinflation and you introduce the reserve currency of the world into the economy, you come up with many other problems, what are usually called by these lady guys unintended consequences. And this is exactly what we have. When in 2009, in the last decade, the market decided to adopt US dollars, and the government followed behind the market and introduced multi-currency. Everybody thought this was a panacea to our problems, and indeed it looked like so for the first 5 years. But it was obvious that what Gloria was referring to is a small house. They are mid houses now in terms of the new bills, but never mind. That this would not really last, but it created the biggest problem we have now in this country of perception and value in what a currency is and what it is not. Because most of us think that a currency is now a good. The economists, you understand what I'm saying? And yet a currency must be a means of exchanging value. I argued with many of my friends, including the chairman of the fund managers, that we already have a currency. This was 2 years ago in Victoria Falls. I said to him, there's a local currency, whether they call it RTGS, whether they call it Eco Cash, whatever name you give it, it's there because people are exchanging value in terms of that. So now coming back to pensions, I will deal with the issue of inflation. Yes, I sit at ZimStat. In fact, I was the founding chairman of ZimStat when it started. Now I chair the governance committee. I'm no longer the chairman. We also get accused by the public and some people here of creating inflation figures simply because of the belief that inflation movement must equate to the exchange rate movement, which is a perception. And nobody's bothered to understand what a basket, that is measure CPI as we call it, contains. And is it the same as your baskets here? The answer is no. So you take your personal inflation of your main house, middle house or small house, and calculate it and think that is national CPI. The answer is no, it isn't. National CPI is about certain basket of goods and services which generally affect the low end of the income bracket of our community. But most of the people who say the figures from ZimStat are false don't fall into that category. When we look at the cost of fuel, for example, we calculate only the weight of the cost of taking a bus or a combi. Because all of us, under the illusion of US dollars, were able to import cars. Everybody had a salary, imported cars. So there are more cars than people sometimes in this town. And the average number of persons per car traveling is just above 1.2. And that's a problem. Those are the same people who are saying things are expensive, but you are using a car to carry one person. Two are supposed to carry 5 people. So it's expensive, and it's true. But that's what CPI. Now, what does, in terms of ZimStat, the inflation that we are calculating is based on the basket. It became 175.6% year on year to June. The government does not come to us to tell us how to calculate it. They actually didn't like the result, I tell you. The minister was kind of upset. But that's what it is. It's a calculation. It's not a political statement. It's just a calculation of inflation. That's what it is. And so therein lies our problem. So for pension funds, I will touch on a few things. I said once again, because I will combine this discussion with the one of the 2009 commission, the belated commission of inquiry, and the talks about compensation, and many other things. But basically, what a pension fund attempts to do, in simple terms, is a situation where people postpone consumption today during their working life in order to spend that money when they're no longer working. And there's one theorem that you must prove for that to be valid. And this theorem goes like this. The rate of reinvestment of the money that you spend from consumption must exceed the rate of inflation of the medium in which the money is reinvested. That is economics 101. Now, once that has not happened, you have a serious problem. And you can't even need a commission of inquiry to understand why that is not working. I told you, the former Minister of Finance, Mr. Beatty, when he was still the minister, I told him that you don't need to go very far. The basic rule of investment is that the rate of reinvestment must exceed the rate of inflation in the medium in which you invest. If it doesn't, you have the very good reason for people not to want to invest. It's almost criminal to encourage people to invest when you know fully well that that rate of reinvestment is negative. So the only solution to that is to have a good economy. You can discuss anything else. You can discuss about compensation. You can discuss about getting your TBs in US dollars. That's not the answer. What you need is a proper economy where the yield curve is correct, where real returns can be obtained. So that is the first thing that I want to talk about. The immediate thing that we see is that the economy hardly gets destroyed, actually. I want just to give you one controversial point before what happens is when you are saving money and somebody is borrowing it in hyperinflation, you are busy transferring value to the borrowers. And I want to argue today that Zimbabwe is the only country that I know of in the world where all the houses, or 90% of the houses in the country, have got title deeds in the bags of the ladies or in the pillowcases or somewhere. There is no intermediation. Houses are fully paid for, and that value is being put under the mattress. And you say, where did the money go? How many of you have worked for 25 years, but you worked for 5 years and bought your house in full? You are the same person saying that my pension lost value, but you bought a house without paying for it. So are we surprised by all this? The scientists said that the entropy change of the universe is constant. So you are not going to destroy the economy. It's busy transferring, changing hands. Even this shortage of foreign currency you're talking about, in 2010, when people had not seen the loopholes in the exchange control system, there was enough foreign currency in the country. People started carrying it in bags and trunks out of the country, and it fell short, and you were surprised again. Why? We export more than Kenya. It has got 40 million people. We have got only 16 million people, but they don't have foreign currency. So what do we have? We have a deficit of confidence between the governing and governed, which is the thing that needs to be addressed to deal with the issue of creating an economy with a correct yield curve so that it's meaningful to put money in pension funds. Now, the immediate problem is that the generation that is close to retirement pays the biggest price in those that have retired, because they are the ones who immediately feel the loss of value. I once put a thesis when I was doing the conversion, and I will tell you about that. I had said that we need an underwriter to do a skewed allocation of assets to older people, because every day that passes, the remaining lifetime is reducing. When you look at this economy, it will recover maybe in 10, 15 years. Those people will be dead. So you better do something for them now. How does that fit? The accountants say you must value assets at fair value. What does that mean? I'm talking about property in this market. Can we have a fair value? Are there transactions that can give us a fair value? This building is 20% occupied, but it's going to be occupied 100% in 5 years' time. Meanwhile, the members that need to receive benefits now are not receiving them because of if Chakut says he must do this and that. In the regulators here, they say you must own liquid assets. But they know only too well that the liquid assets are losing value every day. If we now take the new minimum lending rate of 50% and discount the TBs that we hold in the board, we will increase the poverty of people who are sitting in this room significantly. They are already poor, but you make it worse. Fortunately, we have defined contribution